You've probably been investing for a while now or thinking about getting started, but wondering, with thousands of investment products out there, how should I decide what best to invest in? I don't want to make a mistake and lose all of my money, but I also don't want it to sit around and earn almost nothing. And that's where asset allocation comes in. It sounds like a fancy word, but all it really means is where you put your money. More specifically, how you divide up your money and allocate it to different asset classes. The main asset classes are cash, fixed income, equities, real estate, and alternative investments like art, which I'll talk more about in a bit, and Bitcoin, which definitely deserves some coverage in this video. Before we dive in, if you're looking for an investment platform that charges no commission fees for trades with a simple and easy to use interface to track your portfolio, check out Wealthsimple. I've been using it for about 4 years now, and you can even get a $25 bonus just by using my referral code below and funding your account with $1. Now back to the video. If you Google investment portfolio, you'll find a lot of template portfolios or advice on how to build the best portfolio. The thing is that the best portfolio for one person is not always the best for someone else. To build the best investment portfolio, you need to first understand what your financial goals are and know what your options are. Basically, what you can buy in the supermarket to put in your soup, so you can build a customized, delicious portfolio. Here are some examples. You might be in your 20s and have plenty of time until your target retirement age of 67, at which your goal is to just have enough assets to cover your basic expenses. Or a 50-year-old woman with a $10 million portfolio who just wants to preserve her capital. Anyone here? Or you're someone in your 30s who wants to badly semi-retire at 45 and aims for high growth. Depending on your goals and how you prioritize return versus risk, you should set up your portfolio differently. Don't just follow someone else's advice, especially some random YouTuber on the internet, but learn to think for yourself. That being said, there are some basics to understand about asset allocation that will help you set up your optimal, not perfect, but optimal portfolio. One really important thing to understand is the concept of risk. When you invest your money, you're taking on a risk. Even if you're not investing it and just leaving it in a checking account, you're also taking a risk. The only time when you're not taking a risk is when you use that money to buy Chipotle and eat it. Well, not quite either, but there's where it ends. Anyways, each asset class has a typical level of risk. For example, bonds are typically seen as lower risk than stocks. With a bond, you basically lend money to a government or a corporation for a fixed time, and in return get paid a fixed interest rate, also known as the coupon. This can be anywhere from about 1 to 4% for a government bond and up to above 8% for corporate bonds. One of the biggest risks of bonds is the default risk, meaning the issuer not being able to pay back your principal. So beware of junk bonds. The reason they may pay a 12% coupon is because they have a higher risk of defaulting and investors demanding a higher coupon to compensate them for that. Within the asset class of bonds, the risk highly varies depending on the issuer of the bond. A bond with a AAA rating would be much less risky than one with a C rating. Stocks, on the other hand, are usually seen as being higher risk compared to bonds. Stock prices fluctuate depending on the company's performance and also the economy. If the stock price drops by 50% and you want to sell, then you'll lose half of your investment. Different from a bond where you're basically lending money to a government or a company, and regardless of the company's performance, as long as the company or country doesn't default, they are responsible for paying you back your principal. Cash and cash equivalents are traditionally seen as the safest investment, but I digress. Take for example a GIC or Guaranteed Investment Certificate. When you buy a GIC, usually with a bank, your principal is protected. Let's say that's $10,000, and you'll get a guaranteed return of, let's say, 3% per year. While principal and interest are guaranteed, what many people don't realize is that there's a risk of inflation. That is something that needs to be considered with any investment. Once you take into consideration the level of inflation, and that has been between 2 to 4% in the last 5 years in Canada, excluding the pandemic, and after paying taxes, what is the real rate of return that you're getting? Perhaps only 1%, even 0, or negative in the worst case. And that's why, as a side note, be sure to make use of your tax advantage accounts, like the TFSA and RSP. For more on this, you can watch this video later. The same goes for bonds, especially those that pay interest on the lower end. And what about alternative investments like art? A painting, for example, has an entirely different risk. If you don't understand art, what is in demand, you could invest into the wrong piece and you could also lose a big chunk or all of your money. And that again brings us back to asset allocation. To avoid losing all or a lot of your money by investing in just one thing, you want to invest it in several different kinds of assets. Asset allocation is built on the concept of diversification. This means to spread your investments across different types of assets to reduce risk and increase the potential for stable returns. Diversification means not putting all your eggs in one basket, but instead in several different baskets. Stocks may do well when the economy is growing, and bonds might perform better in times of economic uncertainty. Real estate can provide steady income through rent and long-term value appreciation. The idea is that if the economy is down and with that stocks go down, you still have other assets like bonds or real estate that may perform better to help avoid significant losses. But doesn't everyone want to avoid losses? Yes, in an ideal world, we'd only have returns and no losses. But the reality is that in general, return and risk go hand in hand. If you want a higher reward, you need to take a higher risk. No risk, no gain. But not everyone is prepared to take risks, understandably, because people are at different stages in their lives, have different jobs that are more or less stable, health conditions, and life situations. Someone who is supporting parents with a chronic health condition may not want to put 90% in highly fluctuating stocks. On the other hand, a single person who has a stable job earning $200,000 per year plus a side hustle earning $30K per month could probably afford going 100% in stocks. This has to do with another factor called liquidity. You have to ask yourself, how liquid do you need your investments to be? Cash or GICs are highly liquid. GICs don't pay a lot of interest, but you can usually break a GIC in a few days and have access to the cash, although there might be a small penalty. If you invest in real estate and buy the physical asset, it's not as liquid. It might have gone up to $2 million from the $500,000 you bought it 15 years ago, but if all your money is tied up in there and you need to withdraw money for your kid's tuition, then it will take some time to sell it. And investing in your friend's ice cream parlor might be even less liquid. Stocks and bonds are liquid because they are traded on exchanges and you can sell them anytime except on weekends and public holidays. But if you're pressed and sell them at the wrong time, you could lose a lot of money at once. Different assets have different liquidity, so when you set up your portfolio, it's important to ask yourself how much liquidity you need. I and my husband are a dual income household with no dependents at the moment. We are working in different industries and our income versus expenses results in a healthy buffer each month. And that's why we hold very little in emergency funds. But if your income just covers your expenses, then you'll need to keep a bit more money in cash. Different people also have different levels of risk tolerance, another crucial thing to consider when allocating your assets. Some people are simply more willing to take higher risks, so they allocate much more in stocks than in bonds, while others are just very uncomfortable with risk and stick mostly to bonds and cash equivalents. Usually, when you don't understand anything at all about, let's say, the stock market, you don't want to take any risk. I remember my grandfather who put all of his money in cash, gold, and some GICs at best. And I used to be like that too until I started educating myself more about investing. So if you don't invest in riskier assets because you are risk averse, that's totally fine. Just don't stay stuck with the safest investments because of a lack of knowledge. Another thing to consider in asset allocation is your time horizon. How long are you intending to invest the money for? If you plan to only invest your money for 1 year before you need to get it out to use as your home down payment, then it would be wise not to invest it in highly volatile stocks. Equities, which are mainly stocks, give you a share of ownership in a company. If the company is doing well and there is high demand for the stock price rises. If you bought a stock at $100 and now it's $200 and you sold it, you'll have a capital gain of $100 before taxes. The company might also pay you dividends as long as you hold the stock, which could be anywhere from 1 to 10%, earning you extra money. But different from a GIC or a bond where the issuer is responsible for paying you back your principal, a stock doesn't give you the same rights. Its price can fluctuate a lot and be highly volatile. And the thing is that there's no standard rule for how much a stock can fluctuate in price, and that's why it's very important to understand the fundamentals of a company's business before buying a stock. Professional investors like Warren Buffett have teams dedicated to analyzing the balance sheets, profit and loss statements, and every aspect of a company to pick the right stocks. The problem is that average investors like you and I usually don't have the time or the skill for it. And that's why many people decide to buy ETFs and index funds. It's not an asset class in itself, but rather a basket or a wrapper that contains different shares or bonds. If you buy an ETF index fund like the VFV or the VOO that tracks the S&P 500, you're basically buying a basket that tracks the performance of the 500 biggest companies in the US, and you don't have to pick stocks yourself. If 30 companies perform poorly, there are 470 other companies that can make up for it. As a general rule, if you're fine with leaving your money invested for the long term, let's say 5 to 10 years, and you can endure the ups and downs of the market, then stocks are great for growth. Another thing that you may want to consider when thinking about asset allocation is your age. There is a well-known asset allocation rule based on age that goes like this. To decide what percentage of your assets to put in stocks, take the number 100 and subtract your age from it. If you're 25, for example, it would be 100 minus 25 equals 75% in stocks. If you're 35, it would be 100 minus 35 equals 65% in stocks. And here's what I think about it. For the extreme ends, it's a useful rule of thumb. If you're 85 years old, based on this rule, you would invest 15% of your portfolio in stocks and 75% in bonds. It makes sense because at that age, you're more concerned about preserving your capital and getting some basic returns for your living expenses, but you're not overly concerned about doubling your portfolio in the next 5 years. On the other hand, if you're 20 years old, based on this rule, you would invest 80% in stocks. You still have a lot of time ahead of you and many chances to fail. Your entire portfolio could be wiped out in 2 years, but you still have time to get back up and start over and rebuild the same or different portfolio. But other than that, I'm not the biggest fan of this rule. Why? Because it uses age as a proxy for life circumstances. But in reality, each of us has very unique circumstances, goals, and levels of risk tolerance. Personally, I don't stick to this rule. This is not investment advice, but a possible scenario. If someone is 30 years old, according to this rule, they would invest 70% in stocks. But what if they have a stable income in a stable industry, plus a side hustle, and no dependents? They're investing long term and also prepared to lose their investments and start over. After considering all factors and risks, they may choose to go 90% or even 95% in stocks and benefit from a much higher possible return. Now, after all of this, where does it leave you with your asset allocation? I would say in the beginning, start simple. Don't overcomplicate it because the most important thing is to get started. But also don't just follow template advice. Have clarity on everything we just discussed. Your financial goals, your time horizon for investing, your liquidity needs and your income, risk tolerance, and other specific life circumstances. And no matter how bullish or optimistic you are with any investment, you still need some cash for your daily living expenses. Personally, I like to keep around 2 to 3 months worth of living expenses in some form of cash or cash equivalent. That way, if something happens to our jobs and income, we can still pay our mortgage and eat. You can use the H formula as a starting point, but after that, you need to tweak it and adjust it to your personal situation. Now, let's say for the non-cash part, you arrive at a ratio of 85% in stocks and 15% in bonds. You can further look at the stock portion and diversify it by investing in ETFs or index funds, the basket of stocks. The same goes for bonds. As for physical real estate, carefully consider how much of your assets you want to have tied up in your home. While you want to build up equity in your home, also be careful not to put all of your money in there because a house is one of the least liquid assets. If you want to invest in real estate, alternatively consider REITs that allow you to indirectly invest in real estate without buying the property directly. Alternative investments like art, baseball cards can definitely have a place in your portfolio if and only if you understand them. The reason people need a lot of diversification is actually because they don't know the answer but don't want to make a mistake, as Michael Saylor said. But if you know something that others don't about a specific investment, then go for it. Just be sure to consider the weighting in your portfolio or what percentage you want to invest in it and compare it to the other options that you have. And this brings me finally to Bitcoin. Bitcoin scares many people because they don't understand it. In 2021, I started investing tiny amounts in it because I didn't understand much about it. I first started investing on NDAX, a low-fee cryptocurrency exchange in Canada, and then also bought some on Wealthsimple. You can find the links to both in the descriptions. But I continued to learn about Bitcoin, and as I understood more and appreciated its value, I started investing more and more into Bitcoin, until the point that I'm no longer holding a traditional portfolio with a 70-30 or even 80-20 stock to bond composition. Now, a considerable part of my portfolio is now Bitcoin. Now, I believe that in this day and age, everyone needs to invest in Bitcoin. Opinion, not investment advice. But also that everyone needs to do it at their own pace, meaning that you should spend some time to learn and research about it. Start with small amounts that could be as small as just 1 to 2% of your portfolio, and as you learn more about it and become more comfortable with volatility or price fluctuations, you can slowly increase your holdings. While investing in Bitcoin was controversial for the longest time, I thought that I had to tell you this because otherwise I would be leaving out a very crucial part of my investment journey. Now lastly, here are some mistakes to avoid in asset allocation. Don't aim for perfect because otherwise you'll get into analysis paralysis and not invest at all, which is the worst thing you can do. And don't just follow a template or popular investment portfolio. Your risk profile and goals are different, so put some thought into customizing it. And also, don't just leave your portfolio. Based on your life circumstances and changes in the world, review your portfolio every few months or so and adjust it. So now that you have an overview on asset allocation, you'll definitely want to watch this video on how you can double your money this year.